Welcome back. You're with us on Trading Hour. Our next guest is Aditya Sood of Incred PMS Services. Aditya, good to have you on the show. Thank you for joining in, and season's greetings to you, first of all. So tell us, today we thought we'll talk to you a little more about your approach to mid-caps because PMS, if I look at the Incred mid-cap PMS, then the returns over the past 1 year, 2 years have been quite good. Given that we had this mini shakeout earlier in October, what is the approach that you're taking to the portfolio now?
So I think so we have, slightly tweaked our approach, after taking a super overweight call on small caps in the multi-cap PMS, that was way back in January, March of this year. One is that, we have created a bit of cash, because clearly we have seen some elevation of risk with the, high US bond yields. Crude has rallied substantially over the last 6 months. Obviously, we are getting into state elections, wherein there is a bit of expectation that, possibly it might not be in favor of the NDA, essentially. Another thing is that, if you look at the return expectation, starting of the year, it was generally believed that second half is going to be better than the first half. But obviously, markets have surprised. And what we have seen is that, meaningful outperformance in small and mid caps. At the same time, there are certain areas wherein, we have to be very, very watchful. This is not a market wherein, obviously, the headline indices are cheap in the sense that, they are not as expensive as it was. So I'm talking about the Nifty here. We are trading at 18 times 1 year forward, which is fairly reasonable now. So we see more value in terms of, large caps emerging now, and on the small and mid cap, obviously, it is going to be a sideways to, the market is going to be very, very stock specific going ahead.
Aditya, talking about stock specific, Stuffcraft looks to be a new addition in a significant way, at least, in your multi-cap fund with a weightage of about 3.6%. It wasn't at least in your top 10 holdings a couple of months back. Do you want to talk a little bit about why you added Stuffcraft? What's the narrative there?
So I think so. The top down here is very, very clear. A lot of companies were significantly impacted by inflation. The kind of impact that we saw was a one in a 40-year, sort of impact in the sense that, companies were generating, decent EBITDA margins. Obviously, gross margins were under pressure on account of raw material prices going up. Now, a lot of that has obviously come into the numbers. We are in a very early stage. But what is concerning to many people here is demand. But what we see here is that, since the time went IPO, for example, in the case of Stuffcraft, we saw, margins growing, going from, 7% to 13%. And that is the peak margin. And they obviously, reported a loss, but that loss was categorized because of, they had some one-off impact in terms of, inventory. So our view is that, this is a very, very normalization sort of a stock, wherein the stock made a high of 1100. If you look at, since the time it has got listed. And now, obviously, they are gaining market share. So if you look at, purely Stuffcraft on a bottom-up basis, our view is that, they are gaining market share. And a mean reversion of margin would lead to, a significant beat in terms of profitability from a 2-year perspective. The stock is reasonably cheap. It is trading at roughly 1 time enterprise value to sales, which is not very expensive. Obviously, we have seen a M&A happening here, wherein Crompton acquired Butterfly, that M&A itself happened at 2.2 times sales. So that leads us to believe that there is a significant margin of safety. Obviously, numbers should improve from here on.
Okay, that is on Stuffcraft. Aditya, thanks a lot for joining us. You were mentioning that there are some pockets where you are now being extremely cautious. Can you tell us which are those pockets that you would stay away from completely because of the fact that valuations have run up too much? Which are those sectors that you would just avoid right now?
So one of the things that I've seen is that, where the numbers and narratives don't match, just to take you through, chemicals was a very, very popular theme 2 years back. We completely avoided that sector because, the narrative was China plus one. So if you look at, for example, PSU, stroke defense, stroke electronic manufacturing today, if you look at EMS companies, we have been evaluating the space, but we clearly find multiples to be off by, I mean to say some of these stocks need to correct by 30-50% for us to put in meaningful money. Secondly, we have been thinking about, buying into companies which are reasonably well moated versus, chasing a sector. So EMS being an excellent example, so rather than chasing EMS companies as a sector, what we preferred to do was that, we placed our bet on Tejas Networks, right? Now, if you look at, EMS companies versus Tejas, our belief is that, Tejas is very, very well moated, in the sense that it has got 450 patents. Obviously, they've got a very large house in the form of Tatas to back it. So our view is that, we would like to be focused on, rather than, we would like to buy into the disconnect between narrative and numbers. And obviously, numbers have to match to the narrative for us to, take any meaningful exposure. Secondly, if you look at the fiscal deficit situation of the government and, in the past, for example, in the case of defense companies, what we have seen is that, a fiscal deficit of the government goes up. Obviously, it leads to some sort of pressure in terms of, balance sheet. And then it again leads to a cycle wherein, the working capital management comes to the fore in a lot of these companies. So our view is that, if the fiscal deficit of the government continues to deteriorate, obviously, sooner or later, the balance sheet of these companies will deteriorate. Hence, we are very, very careful on this space.
Okay. All right, Aditya, good talking to you today. Thank you very much for taking out the time and giving us your thoughts on some of these stocks that you own. Appreciate it. We have to take a quick break on that note. On the other side, we'll get you more on the markets.